Climbing delinquencies in Canadian mortgages. Despite the surge in Canadian real estate prices, an increasing number of buyers are struggling to meet their financial obligations. Recent data from Equifax reveals a rise in mortgage delinquency rates during Q1 2023. Notably, households are falling behind on payments more frequently, indicating a potential wave of mortgage delinquencies in the near future. In response, lenders are hastily extending repayment periods for borrowers who are heavily leveraged, aiming to prevent defaults and the subsequent downward pressure on housing prices. In Canada, the mortgage delinquency rate refers to the percentage of total mortgages that are overdue by at least 90 days. This 90-day mark represents the point at which lenders can take action if borrowers do not take remedial measures such as paying off the overdue amount or settling the entire mortgage. While many people perceive a low delinquency rate as a sign of consumer well-being, it actually indicates market liquidity. When borrowers realize they won't be able to catch up on payments, they are more likely to sell their homes. In a robust market, this process can be expedited, allowing the property to be sold before the lender takes any action. However, in slower markets, it takes longer to sell properties, thereby increasing the likelihood of delinquency before liquidation can occur. Mortgage delinquencies are on the rise across Canada. The delinquency rate reached 0.15% in Q1 2023, marking a 1 basis point increase from the previous quarter, representing the highest level since Q2 2022 and the first uptick since 2018. A significant portion of these delinquencies are classified as late and problematic. Approximately 18% of the delinquent accounts are 150 days past due and are considered irrecoverable. Another 63% of delinquent accounts fall between 120 and 149 days past due, nearing the write-off point. The remaining 19% of delinquent accounts are between 90 and 119 days past due, representing a fresh delinquency stage. Early-stage delinquencies suggest that mortgage delinquency normalization might be on the horizon. Accounts that are 30 to 59 days past due experienced a 1 basis point increase over the past year, accounting for 0.18% of mortgages in Q1 2023. Additionally, accounts ranging from 60 to 89 days past due witnessed an annual growth of 0.64 basis points, the largest increase since at least 2019. Mortgage delinquencies have been unusually low, and a return to healthier levels has been widely anticipated. Over the past few years, defaulting on mortgages became exceedingly rare due to a highly liquid market and leniency from lenders, such as offering payment holidays. As these programs concluded, experts predicted a return to more sustainable levels. Recently, Canada's 6 major banks have extended amortization periods to over 30 years for nearly a quarter of all mortgages. This extension assists overleveraged borrowers by reducing their monthly payments over an extended timeframe. Regulators believe this approach can curb delinquencies and prevent downward pressure on housing prices. Having a low delinquency rate is easy if borrowers never have to fully repay their mortgages. However, if lenders are exhausting all measures to prevent defaults and delinquency rates continue to climb, it indicates the presence of underlying structural problems. These problems can escalate from minor failures to major crises that catch everyone off guard.